Hey, welcome back. I'm Rick Harrison, and in this week's Southwest Florida housing market update, I'm going to go over the latest data, inventory levels, and trends in the housing market, as well as the major economic news that will affect your decisions going forward. That's all coming up right here. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome, and if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. All right, so in this week's episode, I'm actually going to be going over a few, not only just the local market stats, we are seeing some similar trends, but some really big news that I think is really pointing towards the fact that the housing is really starting to slow down, but a lot of people are also starting to get worried that there is a crash on the horizon. Whether that's going to be true or not is really going to be up to, I think, the Fed. We're also going to take a look at some articles about the Fed and where things could go depending on what their next moves are. We will get the Fed's latest rate hikes or whatever they're going to do in the next couple of days. So that will start to play out. And then from there, we'll be able to really see how the next couple of months are going to shape up. As if you have been watching, you already know I kind of feel like the fall is going to be make or break, depending on which way the Fed ends up really continuing their marks. But before we get into any of those stories, let's first go over the local market data, and I will pull that up right here. Cape Coral to Naples, last week new listings were at 757, this week 806. That is up 6%. Solds went from 658 to 629, so solds went down. That's also a lagging indicator, and that is indicating that 1 to 2 months ago, we did see a dip in the amount of buyers who were putting in offers, so that is why that is down 5%. Again, same as last week, the interest rates, the mortgage interest rates have actually gone down a little bit again. So that is why we're seeing the pendings up 7%, going from 749 last week to 803. Again, this week, the price decreases are actually up from 835 to 845. Still up there quite a bit. Still not our all-time highs for price decreases, but still up there a good amount. Inventory breakdown. Single families went from 4,800 last week to 4,886 this week. That is up 86, so a net gain there. Condos, which is everything else other than single families, went from 2,083 to 2,113. That's up 30. We had a net gain last week of 106 and a net gain this week of 116. So that's good news. As more inventory continues to build up on the market, we will see more and more price decreases, and that will continue for some time now. Multifamilies, 177 last week, 179 this week. That's up only 2. Not a huge change, but still up three times as much as back in February. Foreclosures went from 48 to 47, just a loss of 1 in this area. Again, this area is from Cape Coral down to Naples. Moving on to the northern part of Southwest Florida, from Punta Gorda up to Sarasota, we see new listings went from 2139 to 2180. That is up 2%. Again, another increase from last week for new listings, and you will see the inventory has increased as well. Price decreases went from 2389 to 2598. That is up 9%. That's a huge move. So we're seeing more decreases up in that area as well. But again, these trends have been continuing for some time, and we will continue to monitor them. Sold 1767 last week, 1651 this week. Again, that's down 7%. That is indicative of what's happened over the last 1 to 2 months as far as people putting in offers. And pendings went from 1976 last week to 2068 this week. So that's up quite a bit. That's up 4%. And again, that is, I believe, due to the fact that mortgage rates have continued to slide down over the last week and a half to 2 weeks. All right, let's move on to the inventory here. Single family homes went from 3652 last week to 3812 this week. That's up 160. And then 1307 to 339 for condos. That's up 32. So last week we had a gain of 235 new listings on the market for week over week. This week, net gain of 192. So still quite significant considering that we didn't see. We only saw 116 this week in the southern part. So we're getting more inventory in the northern half of Southwest Florida as well. Multifamily 76 to 78, that's up just 2. And then foreclosures went from 127 down to 29 this week. That's down 98. So last week we saw it split in half from the mid 200s up to or down to 127. This week we see it go even further. Another 98 go off, similar to last week. So that's down to 29. So again, I think in this area, with the foreclosures and the multifamilies, I believe the northern part of Southwest Florida has a lot more investors entering the market, which, if we're comparing this to bubble standards, usually the more when we're in a housing bubble of sorts, more and more investors enter the market. And if that is any indication, this could be an area where it could be a higher bubble or a bigger bubble. But moving on to the interest rates. Interest rates went from 5.475 last week to 5.275 this week. So again, we're getting back down towards the lower fives. We were at 6s just about a month ago. So this is good news for buyers, as well as the inventory coming on. So that's, everything's kind of working towards a buyer's market. Bank rate has the average going from 5.73 to 5.65 this week, down 8 basis points. So all good news, heading and shifting towards more of a buyer's market, or at the very least more of a normal type of a market, something that's equal versus the extreme seller's market that we've seen over the last 2 to 2.5 years. All right, so getting into the headline highlights. This week, we're going to be looking at a couple stories. Blackstone is ready for a crash, and we're going to take a look at how much money they have going behind them right now. So if that's any indication, if they know something, or if investors, if you're looking at the economy as an investor, Blackstone and BlackRock are both places and companies to look at what they're doing, because that might be an indication of what they think is going on in the economy and the housing market. Also, mortgage rates decline despite higher inflation. We're going to talk about that. I mentioned it last week as far as why that would happen, but we're going to cover it a little bit more detail today. Will the Fed keep hiking or reverse course? We'll take a look at two predictions from two major banks and why they are saying what they're saying. Have we hit peak home prices? We'll take a look at that. New Florida insurance issues, which are going to be, if you're thinking of buying or selling, these are things to consider as a seller. You want to consider this in your pricing and the future of the market. But as a buyer, there's going to be something that might be an obstacle or something that you're going to have to overcome or keep in mind when you're putting in offers. And then finally, BRICS announces a new reserve currency. If you're not familiar with what BRICS is, I'll talk about that at the very end. Let's move on to the actual stories. So first one, we're talking about Blackstone prepares a record $50 billion to snap up real estate during the coming crash. Like I said, if there's anyone that you should be looking at, it's going to be huge investment companies, hedge funds. What are they doing? Right now, Blackstone obviously looks like they're preparing to buy a ton of real estate in the near future. So past 2 months have seen a barrage of negative news coverage, and you can see the headlines right here: is the housing crash starting? Why the housing bubble bust is baked in? These are obviously all talking about both sides of the stories. But what I really wanted to cover is the home buyer affordability index, mortgage index right here. As you can see, it's below any of the levels that we've seen since the 1980s, really. So affordability is at its lowest point, which means that only the top 1%, or a handful below the 1%, can really afford the American dream, really anywhere now. But it also means that just like in 2007, a housing crash is now just a matter of time. At least that's what this article is saying. What is also known is that once housing craters, the largest U.S. residential and commercial landlord, which is Blackstone right now, private equity giant Blackstone is about to get even bigger. That's when it will deploy some or all of the record $50 billion in dry powder it's raised to prepare for just the coming housing recession. So that's according to the Wall Street Journal. Blackstone is in the final stages of raising a new real estate fund that would set a record as the biggest vehicle of its kind, defying market volatility and crowded landscape for fundraising. Right now, private equity and private lending is pretty competitive to get to find money, just because of where the prices are at houses and the amount of deals that you can really find that are cash flowing. But again, like we've talked, if you've been watching the show for a while, these companies don't really care too much about the cash flow. They're doing this for their investors, which is unfortunately almost a self-fulfilling prophecy. It's a vicious circle. You know, people are putting their money into these hedge funds to manage their money and grow it with interest. But these companies are now buying other companies like shares of Blackstone and BlackRock and other REITs, REITs, to then who are then going out and buying real estate to get their investors' interest back. But that is also making affordability unaffordable for the very people who are investing their money in these companies. So it's a vicious cycle, and I think that's kind of what we're getting caught up in. The head of the snake is eating its own tail. So I guess we'll find out in the coming recession, which is already here technically. Blackstone is committing about $3 million of its own capital and has allocated an additional $5.9 billion to investors, which will bring the fund to $30.3 billion when it is finalized. The firm raised the fund expected to be the largest traditional private equity vehicle in history in just 3 months. So that's how much money is trying to get into the housing market or is waiting for the housing market right now. In just 3 months, they raised that incredible and the really historic funds. That's the first story. Moving on to the second story. This is from Zillow, and this is what I really wanted to talk about because we've hit on it a few times in the last couple of weeks. But mortgage rates are declining despite high inflation indicators, and this goes back to what I've been saying. Mortgage rates rely on the bond market, not the Fed. So even the Fed can keep raising the rates. If the bond market doesn't raise the yields on the 2-year or the 10-year, you're going to continue seeing that mortgage rates will continue going down, which is good in a way, unless housing prices continue to go up. And then that makes it a lot easier for the rich to get richer, because they'll be the ones who are still able to afford the prices and take out higher loan amounts at even lower interest rates. So that's the only thing that worries me a little bit, is if prices do continue rising. But if the Fed does reverse course, which I do think they are going to do, that's more of my opinion, in the next 2 months, I think they're going to get this one last hike in, maybe try to get a last ditch effort next month. But other than that, I think they're going to be reversing course, which is going to, ease money policies again. And that's going to give, kind of one final chance for people to really get into the housing market. But I also think in that time, we're also going to see prices continue decreasing for some time. So it's going to be interesting to see how this all plays out over the next couple of months. But mortgage rates declined last week, even with very high inflation indicators. That's because investors continue to price in a potential recession in 2023, which may force the Federal Reserve to begin lowering the federal funds target sometime next year. They're saying next year. I think it's going to be sooner, but again, we will see. As we spoke about last week, it has resulted in an inverted yield curve, which is pretty much not 100% of the time, but 90% of the time is indicating a recession. It's also deepened. The inversion has deepened even more. So that's indicating potentially the level of a recession we're going to be having. So this just talks about the 2-year and the 10-year and how that influences mortgage rates. Like I've been saying, it's not the Fed. The Fed is chasing the bond market. And the Fed will continue to raise rates in the short term, but will have to begin easing once inflation slows and the economy likely slips into a recession. Like I said, I do think we are seeing peak inflation. We'll get those numbers this week, this month. But I do think we are seeing the peak, and once that happens, the Fed will probably reverse course, just to try to save the economy as much as it can. Morgan Stanley sees more Fed rate hikes while JP Morgan actually expects to pivot. So JP Morgan is more along the lines of where I'm at. But again, we have two large companies that are, they're both seeing the same data and looking at it different ways. Morgan Stanley strategists say it's too early to expect the Fed to stop tightening its policy, even as fears of a recession grow, suggesting stocks have more room to fall before finding a bottom. The strategist says bets that inflation has peaked will lead to a Fed pivot and improve The JP Morgan, Chase & Co. strategists say bets that inflation has peaked will lead to a Fed pivot and improve the picture for equities in the second half of the year. Next one is more specific to Florida analysts, actually researchers who've been taking a look at the market and have been comparing data in the past. I've talked about them a couple times, but now they're coming out with some new data. Florida Atlantic University and Florida International University have ranked the most overvalued housing premiums, markets by premiums. So what a premium is the percentage above the long-term pricing trends that buyers must pay in order to buy a property. So the larger the premium, the more overpriced the market is. We already saw two markets that were way overpriced, and we've already talked about them in the past, but now we're seeing another 10 markets decline. So premiums decline in Los Angeles, San Francisco, Seattle, San Diego, Denver, Pittsburgh, Portland, Oregon, Austin, Texas, Ventura, and Stockton, California. And then the other two were Boise, Idaho, and Ogden, Utah, which we've already talked about previous episodes. Until now, only Boise and Pittsburgh have experienced lower monthly premiums, with 10 more markets following suit. It suggests that the home price moderation is spreading and likely to lead to falling values across much of the country, according to these two researchers from these colleges. Premium declines are an early warning sign that prices are leveling off and likely on the way back down, he said. We will look back at this point as the starting gun for the downslope in our next housing cycle. So they also wanted to put right at the end, while the premium declines and 7 average price declines are substantial numbers and suggestive of a slowdown, they'd like to see more data from another month or two before calling the peak. So that's where I'm saying, in the next 2 months, we're probably going to know exactly where things are heading. And we're probably going to see some pretty big shifts and changes in the market. The next one is specific to Florida. This has to do with insurance issues. We've been having insurance issues down here for a while now. A lot of insurance companies, they've just been taking net losses, and some of them actually had to close down. But now we're running into another issue. Florida regulators scrambled Thursday after they said a financial ratings agency notified about 17 insurance companies of potential rating downgrades. So if you've seen The Big Short, you know what rating downgrades really mean when it comes to a stock or a company. The same thing happens with insurance companies. So ratings are important for homeowners with loans owned by Fannie Mae or Freddie Mac because the lending giants require property insurers to maintain an adequate financial rating. If the rating isn't considered adequate, homeowners must find other coverage. And as you know, we've already have a coverage shortage here because so many companies have been leaving Florida due to all the losses that they've sustained over the last several years, and roofer companies, other rehab companies taking advantage of them. If Fannie Mae or Freddie Mac deauthorize a sizable percentage of Florida's insurers based on the dubious ratings of one company, it would create financial chaos for millions of Floridians. So all of this is really based on one company, and that is Demotech. That's right. So Demotech down here, these guys are the ones who are giving these ratings to companies. If they downgrade their ratings, it's going to cause a ton of issues for not only the people who are looking to buy, who won't be able to get insurance easily, but also the people who already have policies, because a lot of the companies have been cutting policies left and right. So that's something to keep an eye out as well. The final one is, this is something I thought needs to be brought to people's attention just because it's something that's not really talked about too much, but it could be a huge deal. Russia and China officially announced a new global reserve currency. So when I said BRICS earlier, what BRICS is, it's a union between these countries over on the eastern half of the globe. What may surprise some people, however, is that Russia and the BRICS countries, so that's Brazil, Russia, India, China, and South Africa, are officially working on their own new global reserve currency, which right now the US dollar is that reserve global currency. Previous episodes, I've also talked about a lot of these countries have been trying to get rid of the federal treasuries however they can. We put a bunch of sanctions on a lot of these countries as well over the years. So they're trying to get out from under the thumb of the US dollar, as well as the fact that over the last, 6 to 10, maybe even 12 months, the US dollar has been getting stronger. You can go back and check the charts and any of the stock charts, but the dollar has been getting stronger, albeit slowly. It's over 107 now. So that's huge. If you remember, in a couple episodes ago, I talked about the euro dollar actually being at level with the dollar. For years, it's been worth more and more, but the dollar's been getting stronger. That's making all the rest of the currencies in the world who are under the reserve currency, the U.S. dollar, it's making their country's currency weaker. So that's what's been causing so much turmoil in a lot of these other places like Sri Lanka and Ghana, a bunch of those countries, some of the countries in the Middle East. They've all been struggling with food and the inflation because the dollar is getting stronger. It's making their currencies worth less. So the issue of creating an international reserve currency based on a basket of currencies of our countries is being worked out, Vladimir Putin said at the BRICS Business Forum last month. President Xi also echoed Putin's sentiments, saying politicizing, instrumentalizing, and weaponizing the world economy using a dominant position in the global financial system to wantonly impose sanctions would only hurt others as well as hurting oneself, leaving people around the world suffering. So they're obviously referring to our sanctions that we've been putting on other countries. Those who obsess with a position of strength, expand their military alliance, and seek their own security at the expense of others will only fall into security conundrums. So a little bit of a backhanded or mild threat there, I think, coming from that. But again, this is something I feel like people need to be aware of, just so, and definitely look up that Ray Dalio video on YouTube, The Changing World Order. It's worth taking a look at how cycles happen, the 100 years cycles and things like that, with economies and global changes of power. Lastly, the wall of worry, couple things. Fed meeting is coming up over the next 2 days. We're looking at potentially 100 basis point hike, which, they're trying not to, but they are a little bit trying to force a recession. Also, the 2-year bond, we're looking at for a federal reverse. So the bond is really been kind of leveling off. It has gone up a little bit in the last day or two, but it's been staying pretty level. So if that does reverse course, we probably will see the Fed reverse course as well. Peak inflation, mortgage rates, those will all come down with the bond, especially the 2-year. Earnings season, the layoff, that's coming up. We got some earnings coming up in the next couple of days, and then over the next few weeks, we'll have more companies coming out. That's going to be, indicative of what's going on with either more stock losses or more job losses coming up. So again, keep an eye out on the markets there. The strong dollar, the dollar milkshake theory. If you haven't checked it out, check it out. It's worth watching some of those videos to understand what's going on with the dollar and why these other countries are looking to create their own global reserve or something that's more, global. Also, it's feeding into collapsing the nations. China and European energy, that's an issue over there. Food obviously has become an issue in quite a few countries, and then also China real estate. Still haven't heard a whole lot. They're pretty, they keep that stuff pretty close to the vest. So we have to rely on secondary stories in order to get some information out of them. And then the final one is, this is something that's starting to happen because of this, what's going on in China real estate and the banks. A lot of wealthy Chinese are trying to emigrate over to, outside of China, basically. It doesn't necessarily mean over to the US, but outside of China because of what's going on. But unfortunately, most of their money's been tied up in the banks, and the banks have been putting freezes on withdrawals. So they're kind of stuck right now. But there's over 10,000 very wealthy Chinese immigrants who are looking to emigrate, but just can't right now. So if we do see some of that come over here, or foreigners starting to buy up more real estate, that could have another effect, an inverse effect on the market if it is declining, because a lot of countries compare our housing rates and some of the mortgages that we can get. A 30-year mortgage, that's not something that they can get in a lot of the other countries overseas. So they look at that as very cheap money, and especially with the rates being where they're at versus what they're looking at over in those other countries, that could throw a wrench into prices decreasing. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know, and don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools, resources, and hot lists. And if you ever want to connect or chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.